Today, we're diving into a set of rules you've probably never heard of, but that totally changed how every major company on the planet talks about money. It's called IFRS 9, and it's kind of like the hidden rulebook for the entire global financial system. I mean, really think about that for a second. How can a bank in Brazil, a tech company in Korea, and a car maker in Germany all report their finances so that an investor in, say, New York can actually compare them? They need a shared language, right? Well, for the most important parts of their business, their financial assets and liabilities, that language is an accounting standard. So, what's the whole point of this? If you dig into the official objective, it's not about making things complicated just for the sake of it. The entire goal is to give investors information that is genuinely useful for predicting a company's future. It's all about making that future just a little less of a guess. To really get our heads around this, we're going to walk through its core ideas. We'll start with what it is, then look at its three big game changers: how it sorts assets, how it peeks into the future for potential losses, and how it handles risk. And then we'll tie it all together to see why this thing matters so much. Okay, so what exactly is this thing? At its heart, you can think of IFRS 9 as the global instruction manual for anything a company owns or owes that's financial. We're talking loans, bonds, derivatives, the fundamental building blocks of the financial world. Now, the key words here are single principles-based framework. See, before IFRS 9, the rules were just a messy patchwork. This standard threw all that out and replaced it with one coherent system. And it's built not on a million rigid rules, but on a set of core principles. This actually forces companies to think about the why behind their accounting, not just mindlessly tick a bunch of boxes. Let's get to our first pillar and see how this actually works: classification and measurement. This is ground zero. When a company gets a new financial asset, like a bond or a loan, the very first question is, what is this thing, and how do we put a value on it? Under the old system, it was a total mess. A company could have two assets that were almost identical, but account for them in completely different ways. It made it almost impossible for investors to get a straight answer. So IFRS 9 just sweeps all of that away by asking a really simple but powerful question. And here's the elegant solution. IFRS 9 uses a simple two-step test. First up, the business model test. It basically asks, what's your strategy here? Are you planning to hold this thing for the long haul, just to collect payments, or are you maybe looking to sell it down the line? Second, the cash flow characteristics test. Is the money you're getting from this asset just the principal and interest, basic loan stuff, or is it something more complicated? And what's so brilliant is how this simple test leads to just three clear buckets. If your whole plan is just to hold a simple loan and collect the cash, you account for an amortized cost, basically what you paid for it, adjusted over time. If your plan is to hold it and possibly sell it, you use fair value through OCI, where you track its current market value, but the ups and downs don't immediately hit your profits. And for everything else, like stocks you're actively trading, it's fair value through P&L, where every little market swing directly impacts your company's bottom line. It creates this really clean line from your business strategy straight to your accounting. Okay, on to our second pillar, impairment. Now, this is arguably the single biggest change that IFRS 9 brought to the table. And it was a direct result of the 2008 financial crisis, which laid bare a massive flaw in how banks were dealing with potential losses. And this slide just perfectly sums up the shift. The old model was completely reactive. A bank would only record a loss on a loan after the borrower had already stopped paying. It was literally like driving by looking only in the rearview mirror. IFRS 9 flipped that on its head. It introduced the expected credit loss model, which is proactive. It forces companies to look ahead, use all the information they have to estimate the losses they expect to happen, and book them now. Now, the official definition calls it a probability-weighted estimate of credit losses. In plain English, that just means you have to think about different ways the future could play out. Good, bad, so-so. Estimate the losses in each scenario, and then weigh them by how likely they are to happen. It's really all about facing uncertainty head-on and planning for it. So how do you actually do this? Well, it all works through this three-stage model. Let's walk through it. Stage 1 is for all your healthy, performing loans. For these, you only have to set aside enough to cover potential losses in the next 12 months. Easy enough. But if the risk on that loan shoots up significantly, maybe the borrower's industry hits a snag, it moves to Stage 2. And now the rules change. You have to account for all expected losses over the entire life of that loan. And finally, Stage 3 is for loans that are already in trouble. The company is on the hook for those lifetime losses here too, but the accounting gets even more strict.
So what does impaired or default actually mean? The standard gives us a pretty clear rule of thumb. There's what's called a rebuttable presumption, which basically means this is the rule unless you can prove otherwise, that a default happens no later than when a payment is 90 days late. It gives a really concrete anchor to that whole stage 3 category.
All right, let's hit our third and final pillar, hedge accounting. This is all about how companies report the tools they use to manage their financial risks, things like sudden changes in interest rates or foreign currency values. The goal here couldn't be simpler. Make the accounting match what's happening in the real world. Before IFRS 9, the rules for hedging were so rigid and complex that a company's financial reports often didn't show what the risk management was actually achieving. It just painted a distorted picture. So the huge change IFRS 9 made was to align the accounting with the actual business strategy. So now, if a company uses a derivative to protect a bond from interest rate swings, the accounting actually shows that. If they lock in an exchange rate for a big purchase they're planning to make overseas, the financial statements reflect that decision. Simply put, the numbers on the page finally tell the real story of how a company is managing its risk. Okay, so we've covered the 3 pillars. Let's pull back and look at the big picture here. Why does all this technical stuff actually matter? It really boils down to these 3 massive shifts. First, it brought a logical, common-sense approach to sorting assets. Second, and this is the big one, it forced the entire financial world to be forward-looking about risk. And third, it made the accounting for hedging make sense in the real world. And that, ultimately, is the story of IFRS 9. It was a fundamental change in philosophy. It took financial reporting from being a reactive, history-telling exercise to being a proactive, forward-looking discipline. It's no longer just a record of what's already happened, but a sober assessment of what might come next. And that leaves us with the biggest question of all. By forcing the entire financial system to look through the windshield instead of the rearview mirror, has IFRS 9 actually made our global economy any safer? That's the multi-trillion-dollar question that everyone is still trying to answer.